Most investors believe the market crashes when something terrible happens. That's not what history shows. Markets break when liquidity breaks, when the dollar tightens, when credit spreads widen, when refinancing costs jump, and when the Federal Reserve stops acting like a safety net. The next major drawdown will not announce itself with one headline. It will build quietly in the plumbing of the financial system, and by the time it reaches your portfolio, selling will feel obvious, which is exactly when it's usually too late. At 9:30 a.m. in New York, a bell rings and millions of investors, professionals and first-timers alike make the same silent bet that the future will look enough like the past for their portfolio to survive it. But the market does not reward optimism, it rewards preparation. And over the last 2 decades, the United States has moved through 3 defining financial regimes: near-zero interest rates, post-pandemic inflation, and the sharpest Federal Reserve tightening cycle in a generation. Each regime quietly rewrote what successful investing actually means. This is the uncomfortable truth most people learn too late. You don't lose money in the stock market because you picked the wrong stock. You lose money because you followed the wrong rules for the world you were living in. You invested as if rates would stay low forever. You assumed inflation was gone. You believed diversification meant owning 20 tech companies instead of 1. You confused a bull market with skill. The purpose of this documentary is not to predict the next headline. It's to build a durable framework, 5 rules, designed to survive the next inflation scare, the next liquidity crunch, the next geopolitical shock, the next crypto boom and bust, and the next recession that arrives right when consensus swears it cannot. These 5 rules are not slogans, they are responses to how modern markets actually work through the US dollar system, Federal Reserve policy, corporate earnings, and the global supply chains that determine prices in every American household. To understand why these rules matter now, you have to start with how we got here. After the 2008 financial crisis, the Federal Reserve effectively rewired capitalism's pricing mechanism. Rates were cut to near zero and stayed there for years. Quantitative easing pushed liquidity into financial assets, compressing risk premiums and inflating valuations. In that world, investors were conditioned to believe drawdowns were temporary and bailouts were guaranteed. Buy the dip wasn't a strategy, it was a reflex built by a central bank put. Then came 2020. Pandemic shutdowns shattered supply chains, fiscal stimulus flooded household balance sheets, and demand snapped back faster than production could recover. Inflation, once dismissed as a relic, became the dominant variable. By 2022, the Fed pivoted from supporting markets to restoring price stability. Rate hikes didn't just raise borrowing costs, they repriced every asset class on Earth. Stocks, bonds, real estate, venture capital, and crypto all had to adjust to a world where the risk-free rate was no longer zero. And as inflation spread across essentials, food, shelter, energy, politics followed. US-China tensions hardened, industrial policy returned, and global trade started reorganizing. BRICS headlines hinted at a longer-term question: what happens if the world gradually reduces dependence on the US dollar? Not a sudden dollar collapse fantasy, but a slow diversification of reserves, trade settlement, and commodity flows that could make inflation more persistent and interest rates more volatile. This is the backdrop for the 5 rules, because successful stock investing is no longer about finding the next hot ticker. It's about building a portfolio that can function under monetary tightening, deglobalization pressures, commodity shocks, and an information environment engineered to trigger emotional decisions. Rule 1 is simple, and it is the foundation beneath everything else. Invest according to the regime, not the narrative. In the zero-rate era, investors could overpay for growth because discount rates were negligible. When rates rise, the math changes. A company that promises profits 10 years from now is worth dramatically less when Treasury yields reset higher. That is why 2022 punished long-duration assets from unprofitable tech to speculative crypto while rewarding cash flow and pricing power. The regime is shaped by 3 forces: inflation, interest rates, and the US dollar. Inflation determines how aggressive the Fed must be. The Fed determines financial conditions, and the dollar transmits that policy worldwide, tightening or loosening liquidity far beyond American borders. When the dollar strengthens, global dollar debt becomes harder to service, emerging markets strain, commodities often weaken, and risk appetite fades. When the dollar weakens, liquidity tends to improve and global assets can rally. This is not theory, it's why rallies often fail when the bond market refuses to cooperate. It's why earnings can be good, yet stocks fall if rates rise. And it's why the best investors obsess less over headlines and more over the policy impulse, whether the Fed is tightening or easing, and whether inflation is re-accelerating or cooling. If you want to protect and grow wealth, you must ask one question before you buy anything. What happens to this investment if inflation reignites and rates stay higher for longer? Then ask the opposite. What happens if a recession forces the Fed to cut? Assets behave differently in each scenario. Successful investing starts with admitting you don't control the regime, but you can position for it. Rule 2. Treat valuation like gravity because eventually it wins. Valuation is not an academic debate. It is a risk control tool. When investors ignore valuation, they are quietly borrowing returns from the future, and the bill always arrives, usually during a period of tightening liquidity. The past decade produced a dangerous illusion that great companies are always great investments, but a great company purchased at the wrong price can be a terrible investment for years. In an environment of high inflation and higher real yields, the market becomes less forgiving. Multiples compress, capital gets expensive, investors demand profitability now, not stories later. Valuation is also where the macro world meets corporate reality. Higher rates raise interest expense. They slow housing and consumer demand. They pressure margin. They challenge highly leveraged balance sheets. The same stock can look cheap based on last year's earnings and dangerously expensive based on next year's cash flow if the economy rolls over. This is why professional investors keep returning to a disciplined process. Compare valuation against normalized earnings, not peak earnings. Stress test margins. Look at free cash flow, not adjusted numbers that exclude recurring costs. Measure debt maturities. If a company has to refinance at 7% instead of 3%, its future looks different even if its product doesn't change. And this rule extends beyond stocks. It applies to crypto market cycles as well. Bitcoin and Ethereum can be revolutionary technologies, but they are not immune to liquidity. When real yields rise and the dollar strengthens, speculative appetite typically fades. When the Fed pivots and liquidity returns, risk assets, including crypto, often surge. The point is not to hate or love an asset class. The point is to understand what you are paying and what conditions must be true for your price to make sense. Rule 3. Buy resilience, not hype, because the next shock is always different, but it always arrives. The world has entered an era where shocks are not rare events. They are part of the landscape. Supply chains can be disrupted by war, sanctions, shipping bottlenecks, or semiconductor restrictions. Energy markets can swing on OPEC Plus decisions, Middle East escalation, or unexpected refinery outages. Food prices can jump with droughts or geopolitical blockades. Meanwhile, the US fiscal trajectory, persistent deficits, and rising interest costs adds its own pressure to the bond market. In this environment, the most undervalued asset is resilience. In stock investing, resilience shows up in specific, measurable traits: strong balance sheets, pricing power, recurring revenue, diversified supply chains, and management teams that allocate capital rationally rather than chasing momentum. When inflation spikes, companies with pricing power can protect margins. When credit tightens, companies with low leverage can keep investing, while weaker competitors retreat. When recession hits, businesses tied to essentials tend to endure better than those dependent on discretionary splurges. Resilience also means understanding sector concentration risk. Many Americans believe they are diversified because they own an S&P 500 fund, but the index can become top-heavy, dominated by a handful of mega-cap names. That can work brilliantly until it doesn't. Until regulation, taxation, antitrust pressure, AI capex cycles, or simply valuation mean reversion changes the market's leadership. A resilient strategy respects that leadership rotates. It recognizes that commodities and real assets are not old economy relics, but potential inflation hedges. It acknowledges that gold is not a growth asset, it is monetary insurance. Gold tends to matter when confidence in paper promises wobbles, when real yields fall, or when geopolitical risk rises. Silver adds industrial sensitivity, often amplifying moves in both directions. Energy and industrial metals link directly to the physical economy and the cost structure of modern life. Even in crypto, resilience exists, but it looks different. It means recognizing the difference between decentralized assets with long-term network effects and speculative tokens that depend entirely on liquidity and marketing. It means understanding stablecoins as a bridge between traditional finance and crypto markets and monitoring regulatory risk, reserve transparency, and dollar funding conditions. In periods of stress, stablecoin dynamics can reveal where leverage is hiding. The point is not to turn every portfolio into a bunker. The point is to own assets and businesses that can function in a world where shocks happen and capital is no longer free. Rule 4. Manage risk like a professional. Because the market punishes amateurs with perfect timing fantasies, most investor damage doesn't come from a bad idea. It comes from an unmanaged position size, an unrecognized correlation, or a liquidity mismatch. People think they are taking a little risk because each position seems small. But when everything is tied to the same factor like low interest rates or a strong consumer, your portfolio is one trade disguised as diversification. Risk management starts with time horizon. If you need the money in 2 years, you are not investing, you are speculating. If your timeline is 10 years, volatility is not the enemy. But even long-term investors must manage sequence risk. The danger of large drawdowns early in retirement or at the wrong life moment. It also starts with liquidity. In every crisis from 2008 to the 2020 panic, liquidity disappeared first. Assets that traded smoothly in calm markets gapped lower when forced selling began. This is why investors should be cautious with leverage and cautious with crowded trades. Leverage turns volatility into permanent loss when you're forced to sell. A professional approach doesn't require complex derivatives. It requires discipline. Diversify across true drivers of return, rebalance periodically, and avoid the psychological trap of turning a trade into a marriage. If your thesis changes, rates rise, inflation returns, earnings deteriorate, your positioning must change too. This is also where investors should pay attention to the banking system and credit markets, not just stock charts. Banks are the transmission mechanism of monetary policy. When lending standards tighten, it often foreshadows slower growth and weaker earnings. Credit spreads widening can be an early warning that equity optimism is out of sync with financial reality. In recent years, we saw how rapidly confidence can shift when bank balance sheets are pressured by unrealized bond losses in a rising rate environment. Even when systemic collapse is avoided, the economy can feel the aftershock through tighter credit. Risk management means you don't wait for headlines to confirm what the bond market already priced. Rule 5. Compound quietly, because the real edge is behavior, not brilliance. The market does not consistently reward intelligence, it rewards consistency. And compounding is brutally sensitive to investor behavior. Missing a handful of the best days can destroy long-term returns, but so can panic selling after the worst days. The tragedy is that both mistakes are usually caused by the same impulse, reacting to volatility as if it is information rather than noise. Compounding works when you stay invested, but staying invested requires a strategy you can live with when the news turns dark. That means setting realistic expectations. Stocks do not go up every year. They do not even go up every decade in a straight line. Wealth is built through cycles, not despite them. This is where dollar cost averaging becomes more than a slogan. It is a behavioral tool that reduces the need for perfect timing. It also ensures you participate when assets are cheap, when fear is loudest, and conviction is rare. Compounding also requires clarity about what you own. Investors should be able to explain in plain language why a company will be more valuable in 5 years. Not because a chart suggests it, but because cash flows, competitive advantage, and balance sheet strength suggest it. If you cannot explain it, you probably do not understand it. And if you do not understand it, you will not hold it when volatility arrives. Now, with these 5 rules established, the real question becomes, what happens next? The next chapter of markets will be shaped by a tension the US has not fully resolved. On one side is the Fed's need to prevent inflation from becoming entrenched. On the other is the economy's sensitivity to higher rates after years of cheap debt. Add the reality of large federal deficits, ongoing geopolitical risk, and an electorate with limited tolerance for economic pain, and you get a volatile policy environment where confidence can swing quickly. If inflation continues to cool, the conversation shifts to rate cuts, soft landing narratives, and risk-on rallies. In that world, equities can climb, credit spreads can tighten, and crypto markets can regain momentum as liquidity expectations improve. If inflation reaccelerates through energy shocks, supply chain disruptions, or persistent wage pressure, the Fed may be forced to stay restrictive longer, making valuations vulnerable again. And if recession arrives, earnings become the problem, even if rates fall. Investors should not pretend to know which path is guaranteed, but they can prepare for all of them. Preparation, in practical terms, means building a portfolio with multiple engines, quality US. Equities with real cash flow, a layer of defensiveness through duration exposure appropriate to your risk tolerance, and selective real asset hedges such as gold or broad commodities if inflation risk remains. It means treating Bitcoin as a high volatility, liquidity sensitive asset, potentially a long-term hedge against monetary disorder, but not a substitute for a balanced plan. It means maintaining dry powder cash or short-term treasuries so opportunity is available when fear forces indiscriminate selling. And above all, it means respecting the core lesson of every financial crisis. The future arrives faster than your emotions can adapt. The 5 rules are not designed to make investing exciting. They are designed to make it survivable. Regimes change. Narratives collapse. Winners rotate. The dollar strengthens and weakens. Inflation fades and returns. The Fed pivots, then pivots again. Through it all, the investor who wins is not the one who predicts every turn. It is the one who never violates the rules that keep them in the game. Because in markets, longevity is the ultimate edge, and the quiet discipline to keep compounding through tightening cycles, through geopolitical shocks, through crypto manias and commodity spikes is how ordinary investors build extraordinary outcomes. If you remember nothing else, remember this: successful stock investing is not about being right tomorrow. It's about being prepared for whatever tomorrow brings and still being invested when the next decade begins.